I'm Steve Minnell, your host for today's webinar on claiming Social Security. I'm speaking to you from our headquarters in Fayetteville, North Carolina, where I'm joined by our Senior Investment Strategist, Russell Huker. We have about 30 minutes of slides for you today, and then we'll leave plenty of time for your questions. We did have about 500 people register for this webinar today, so if we don't get to your particular question, we will follow up with you afterwards. Since you are muted here, but we still want questions, please ask them by typing them into the questions block on your screen. Don't be shy about it. Your feedback helps us develop this webinar series in a way that is best for you. In the coming week, if you ask detailed questions, we're going to be following up with you one-on-one. So again, if we skip over your question, don't worry about it. One question I always get here, and I'm going through some administrative stuff as I see more people piling into the webinar, is can I get a copy of these slides? And the answer to that is yes. There's a new feature in GoToWebinar if you look at your control panel called Handouts. And if you go to Handouts, you'll see two links to PDFs. If you just click on the blue link that says Claiming Social Security Presentation, you'll get a copy of this presentation. And the other one is an input form for some analysis that we're going to offer later on in the presentation. So this monthly webinar series is brought to you by AAFMAA Wealth Management Trust, where I'm the CFO. We are AAFMAA's trust company. AAFMAA is the American Armed Forces Mutual Aid Association, which was formed in 1879 to provide prompt and substantial relief to survivors of soldiers killed in action. Today, we continue that legacy of protecting members of the military community. At AAFMAA Wealth Management Trust, we accomplish this by being the premier provider of financial planning, investment management, and trust services for the military, not for profit. As a trust company, we have an additional legal obligation to act as your fiduciary. That is only in your best interest, for your benefit. Here's an important disclaimer. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. So please do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will obviously differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. In this case, today's presentation on claiming Social Security focuses on one aspect of retirement planning, which is one of 6 focus areas of our comprehensive financial plans. Okay, my part's done, Russ. Let's start talking about claiming Social Security retirement benefits. Over to you.
Thanks, Steve. Good afternoon, everybody, and happy holidays from AAFMAA Wealth Management Trust. We'll go ahead and get started here. Not sure how many folks associate Social Security with an actual strategy. We talk about strategy in terms of games like chess or sports like football. Social Security is no different. Just like winning a chess match or a football game, it involves careful planning, and so should your Social Security claiming strategy. As the slide says, there are literally hundreds of claiming combinations, but the one that's best for your situation will analyze all the pertinent factors that play a part in your benefits. Getting it right is critical. You will be locked into your choices with little opportunity to change your mind, and you could be leaving a lot of money on the table. Our presentation today is designed to give you the basics you need to know and consider as you plan. But there's no way we can give you all of the answers here. This is complicated and you will need advice. The Social Security Administration agents are prohibited by policy from giving you advice. They can answer some of your questions, and by the way, you will often get inaccurate or contradictory information from them, but they can never give you advice. To that end, I was recently talking with a prospective client that's interested in our services. He told me that he'd been in contact with the Social Security Administration and he had received 3 separate and yet different pieces of information. That's where AAFMAA Wealth Management Trust can help. And we'll tell you a little later about how we can do that for you. Common questions. These are the most common questions that most people are asking about Social Security benefits. How much will I receive? What's the best time and way for me to claim benefits? And what about the recent changes I've heard about? We're going to answer some of these questions today, and I'm thinking you're going to be surprised by the answers. The Bipartisan Budget Act of 2015 was signed on November 2nd, 2015. It created a few changes to Social Security. The main two changes impact ways to claim benefits or strategies. These two strategies were commonly called file and suspend and filing a restricted application. They were rules within Social Security law that made it possible for Social Security beneficiaries, particularly married couples, to get more in benefits. However, even with these two strategies, or without these two strategies, I should say, there are still plenty of ways to claim benefits in a way that maximizes your cumulative lifetime benefits and protects your family against longevity risk. There's definitely no need to panic about your benefits. More on this window later. How much you will receive in Social Security benefits is based upon a number of factors. First, it's based on how much you've earned over your lifetime. The more you've earned, the greater your benefit will be, up to the maximum benefit amount. In 2015, the maximum full retirement benefit is $2,663 a month. In order for your full retirement benefit to be that, you must be turning 66 in 2015 and have earned the maximum Social Security wages for basically every year of your career. Your benefit amount is also determined by the age at which you apply for benefits. If you apply earlier than your full retirement age, benefits will be reduced. If you apply at age 62, you will only receive 75% of your full retirement benefit. If you apply after your full retirement age, you'll get more. You can see in the example above, it pays to collect benefits later. Benefits are also impacted by your marital status. Married couples can use the rules of spousal benefit to their advantage. Also, survivor benefits for widows and widowers have their own set of rules that may be advantageous for you. Finally, if you're divorced, you may be eligible for a divorced spouse benefit on your ex-spouse's earnings record. Here's Joe and Mary. Joe's born in 1959. He claims $2,018 a month retirement at age 66, which is his full retirement age, or FRA. Mary was born in 1949 as well, claims her $1,267 a month benefit at age 66, her FRA. Joe expects to live until 80, Mary until 90. And if they live to those precise ages, they will collect about $814,000 in cumulative lifetime benefits. And while that sounds pretty good, let's remember Joe and Mary. Later we'll talk about how they can get even more. The Social Security Administration uses a formula to calculate your benefit amount. They look at your highest 35 years of earnings. If you do not have 35 years of earnings, they will average in zeros for those missing years. In order to qualify for any benefits at all, you must have at least 10 years of earnings on which you paid Social Security taxes. The amount you receive when you first start your benefits sets the base amount you will get for the rest of your life. Your actual benefits are based on your primary insurance amount, which is also known as your PIA, arrived at through a formula that is applied to your earnings. Your PIA is also your full retirement benefit, or the amount you will receive monthly if you begin your benefit at your full retirement age. Your monthly benefit can increase in a couple of ways. First, if you continue working and contributing to Social Security, your benefits will be recalculated each year to reflect that. Second, your benefit will increase in years that cost of living adjustments are given. You can also get lower monthly payments for a longer period of time, or higher monthly payments over a shorter period of time. You can find your benefit amount by going online to www.ssa.gov /my statement. You will set up an online account and receive your statement immediately via a download link. Your statement will look much like the Social Security statements that used to be mailed to your home each year. And incidentally, those statements will be mailed each year to all workers age 60 and older. The impact of filing early. As you can see from the slide, if you file before your full retirement age, your benefit will be reduced. When thinking about the reduction, think backward from age 66 to 62. Your reduction in the first 36 months from full retirement, that is from 66 back to 63, is 0.09% a month, which is equivalent to about 0.5%. From age 63 to 62, it's an additional 5/12 per month, which is equivalent to about 0.41%. So if you add up the 0.55 and the 0.41s for all the months that are applicable, that equals 25% in reduction, which means that age 62, you'll receive 75% of your full retirement benefit. Delayed retirement credits. The bottom line is that for every month beyond your full retirement age that you wait to claim a benefit, you will also receive a credit of 0.2% more. These credits are not compounded, but they do add up. If you wait until age 70 to claim your benefit, you will receive 32%, or approximately 8% more a year in benefits than if you began at your full retirement age of 66. When should I start my benefits? It depends on a number of factors. Some are listed on this slide. For right now, let's set aside age, health, and longevity. We'll take a closer look at those later. But the other factors listed relate to your financial portfolio. Some of you may need income early, while others may be more concerned about having the highest income possible later when your savings may be running low. Some of you may plan to work longer than others. Regardless, when you begin, benefits should be looked at holistically with your complete financial picture so that you can make the best choice for your situation. The graph on this slide illustrates how the decision of how and when you take Social Security can impact your portfolio longevity. The case represented by this graph is of a single individual with about $700,000 in retirement assets, earning 5% annually and a 3% CPI, inflation factor. Each of the colored lines represented shows how the retirement portfolio is consumed based on the age in which the individual claims retirement benefits, ages 62 through 70. If Social Security is taken early, that income enables you to draw less from your retirement portfolio in those years. Of course, the converse is true also. If Social Security is delayed, more income for living must be withdrawn from the portfolio. So the size of your retirement portfolio shrinks more quickly while you wait to draw your retirement benefits. As you can see, when Social Security is claimed at 62, the portfolio runs out of money in 2039. If Social Security is delayed, the portfolio lasts until sometime in 2046, or about 7 years longer. Even though more income was withdrawn from the portfolio early, the spend down takes longer with a delayed strategy. The lesson is that how and when you claim Social Security makes a substantial difference in how long your retirement savings will last. Maximizing your benefits and using a smart strategy that protects you against longevity risk makes a material difference in your retirement income and portfolio longevity. What is a claiming strategy? A claiming strategy is literally the act of combining all of the complicated rules into a personalized plan for you to claim benefits for a particular outcome. The outcome may be maximize cumulative benefits. It may be income at a particular time. It may also involve switching benefits at a particular time, or turning on or off a category of benefits at a particular time. But if you don't know all the rules, you may miss an important factor in your strategy. take a look at spousal benefits. Married couples can take advantage of more strategies to get more in benefits. Spousal benefits garnered in combination with retirement benefits can mean that the addition of thousands of dollars more in benefits each year. Even if a spouse has never worked outside the home, he or she can claim a spousal benefit on the worker's record. If the husband's full retirement benefit is $1,200 a month, the wife can claim up to 50% of that amount as a spousal benefit. It's important to note that spousal benefits do not earn delayed retirement credits, so they are never more than 50% of the earner's benefit. However, if you claim a spousal benefit prior to your full retirement age, the benefit is reduced. If you claim at 62, your spousal benefit will only be approximately 38% of the earner's full retirement. The recent changes brought about by the Bipartisan Budget Act of 2015 included some grandfathering for two groups. First, if you or your spouse was born before May 1, 1950, you fall into the grandfathered group. There are claiming options that are still available for this small window through May 1 of 2016. You must reach age 66 before May 1st, 2016 in order to use these claiming rules. You may have read about these rules. They were known as file and suspend. If you are grandfathered, we can complete a claiming strategy analysis and make a recommendation on how you can claim benefits using file and suspend. The second grandfathered group is those born January 1st, 1954 or earlier. This group will be able to take advantage of the file restricted application. This is only possible at or after your full retirement age and is effectively being phased out over the next few years. It allows a spouse who reaches full retirement age to choose whether to claim his or her own retirement benefit or to begin a spousal benefit and let the retirement benefit grow. If you fall into this group, born January 1, 1954 or earlier, we can help you determine if you can use a file a restricted application. Let's go back to look at Joe and Mary again. Remember, with their plan for collecting Social Security, they will receive about $814,000 in cumulative lifetime benefits. Joe and Mary, however, are both age 66 and can use the old rules to claim benefits. Let's look at a better strategy for them that uses some of the old rules. Mary will claim her benefits a little early at age 63 and 10 months. With her reduction in benefits, she'll still collect about $1,084 a month. At his full retirement age, Joe will collect a small spousal benefit of $634 from Mary's record. Joe claims his own benefit at age 70 when it has grown from $2,018 a month to $2,664 a month. This increases the cumulative lifetime benefit by over $107,000, which means that's $107,000 less will have to be withdrawn from their savings. That means that the survivor benefit paid to one of them will also be $2,664 versus $2,018 a month if Joe were to have begun his retirement benefits at his full retirement age of 66. But what if you don't fall within the grandfathering? What's possible for you? If you don't fall under these old rules, please don't be tempted to just claim early because it's easy. The rules are still very complicated, and there are some that you may miss, which could cost you thousands of dollars. Again, AAFMAA Wealth Management and Trust can show you the strategies that apply to your situation, and we can show you the trade-offs between strategies in a side-by-side comparison. Selecting the best claiming strategy for your situation can only be done by analyzing and comparing your options. Let's look at another example. John and Abigail were both born after the birth dates that would allow them to take advantage of the old rules. Instead, when John and Abigail are ready to claim benefits, they will be under the new rules. John is 61 and Abigail is 59. You'll remember that we talked about PIA earlier, primary insurance amount. It's the equivalent of the benefit you will receive if you claim at exactly your full retirement age. It's the amount that is reduced for an early claim and increased for a claim beyond full retirement age. John's PIA is $2,365 and Abigail's is $1,178. Their respective life expectancies are 80 and 90. In our example, Abigail is going to begin her benefits a little before her FRA at 64 and 7 months. John will start his benefit at 70, and Abigail will qualify for something known as spousal excess, meaning that when John begins his benefit, she'll get a bump in hers. This strategy is one that will likely pay them the most cumulative lifetime benefits, somewhere over $996,000. Keep in mind these dollars are all reflected in today's dollars. Their benefits will also grow with cost of living adjustments. The cumulative lifetime difference between this strategy and claiming early is over $163,000. That means John and Abigail get $163,000 more if they wait to claim. But the most important factor to point out is that Abigail's survivor benefit will be $1,171 more every month with a delayed strategy. If Abigail lives longer than planned, or if her savings begin to run out later in life, she can count on the higher benefit for the rest of her life. When you claim matters. Now, first, we hope that you better understand that when you claim does matter. Sometimes it can be a matter of a month of waiting that will make a substantial difference in the lifetime benefits you receive. The rules are complicated and they are plentiful. While you may be able to do some internet research and learn a few of the rules, the likelihood that you'll overlook something important is significant. You need help with the rules, and we can make it simple. There are many combinations of those rules that can help you. We use powerful software coded with all the rules to tell you the exact strategy that will get you the most in benefits. And we, again, can help you compare other claiming strategies side by side. Because your decision is irrevocable beyond 12 months, it's critical that you get it right. You cannot afford to make a mistake. Some of you have a limited time to take advantage of the old rules to get more benefits. Don't delay. Come see us immediately. You need the expert advice. AAFMAA Wealth Management Trust can remove the complexity and make it simple for you. I mentioned that AAFMAA Wealth Management Trust uses powerful software. Let's talk about what that means for you. With only a few pieces of information that you give us, and we don't ask for your Social Security number, you can get a full Social Security analysis and recommendation. It's a multi-page personalized report that gives you a recommended claiming strategy. It educates you in simple terms how Social Security works and how your benefits are calculated. There are graphs and charts that are easy to read. It gives you the answers you'll need. Next steps. Our fee for providing this report shall be $250 payable prior to report preparation. This report is part of AAFMAA Wealth Management Trust's full financial planning capabilities. For any client who subsequently elects to have a comprehensive financial plan prepared, the $250 paid for the Social Security Analyzer report will be credited against the full fee of $2,100 for a comprehensive financial plan. Grandfathered AAFMAA members, those that bought a value-added whole life policy before July of 2000 that is still in force, will receive this report at no charge. Please provide your member number to request a fee waiver. If you are viewing this webinar live, you can download the data input form and the GoToWebinar control panel, as Steve mentioned earlier. Please complete it and submit it with your copies of your government IDs and payment, and we'll get your analysis started immediately.
Excellent, Russ. Thank you very much. That was a great discussion of how to claim Social Security retirement benefits. So now, what are your questions for Russ? I have a couple canned questions that we received earlier. There's about a dozen in the queue here, and I'm going to select some of those. But please ask more if you think of them. Okay, Russ, the first question, and I'm combining a couple questions here together to try to capture bigger ideas. But if you wait and draw Social Security after 70 years of age, do you get any additional benefit by waiting longer, or does it max out at 70?
No, that is the maximum age. You cannot wait longer than that, or I guess you could wait, but you will not earn any more deferred credits. 70 is the maximum age at which deferred credits will be earned. It will be your maximum benefit.
Okay, good. And you mentioned this a couple of times during the briefing, but a couple of people I asked. Exactly how much longer can we sign up for the file and suspend strategy?
The file and suspend strategy window is open only until May 1st of 2016. So there's a very short window of time to take advantage of that opportunity. It truly is a great strategy to utilize it if you fall within the parameters that make it applicable to you. And we certainly can help you determine if that will work for you.
I'm going to throw out a general question here that I've received a few times during this briefing. I'll pick one. So I'm still working. What are the advantages and disadvantages of taking Social Security? So we focused on the advantages of delaying to maximize lifetime benefits and survivor benefits. But what are some of the other things that members might want to think about?
Well, if you're currently working and you don't need the additional income, then you should let it sit and earn deferred credits. Also, if you take it, you're going to be increasing your tax base. You may push yourself into a new tax bracket. So, and as we talked about before, if you can push that off until a later date, you're going to guarantee a higher spousal death benefit for your spouse.
So under what circumstances might it make sense to withdraw early? A couple people in here talk about how they've been planning to start drawing at 62. Does that make sense in some situations?
Well, if your expectation of your longevity is somewhat less, if you've got a family history of folks passing away earlier, then it may make more sense to take it early and just take advantage of it. And that's something that that we can certainly talk about with you and help you determine. We can run different scenarios within the software. I can adjust the life expectancy plus or minus 10 years. So, if you want to see something that is less than 80 or 90, as we've kind of proposed within the webinar here, we can run that for you at different ages and see if the strategy changes somehow. And it may very well happen. That's the best way to test that hypothesis.
Here's a good one that just came in. This particular member, their family has 2 military retirements, but the general question is, how should I think about military retirement when I'm selecting my Social Security claiming strategy? How does military retirement affect our retirement decisions and planning?
Well, a lot of times, and this is, it's a very select group of the military, is with respect to pensions, the general public does not have that any longer, so that's a real benefit to military folks. So a lot of times what we find is that the ability for people to push off the start date for Social Security benefits is a viable solution, which gives them the delayed credit opportunity. If you think about it this way, where else can you go get a guaranteed 8% return on your investment? So it's a pretty strong way to think about it as well. So given the fact that pensions are available to military folks, it does present the option for a little bit more flexibility, we find.
Yeah, that's a good way to think about it. defined benefit retirement plan like you get in the military is effectively another retirement asset that you have. So perhaps it allows you to wait later. Let's see. Thanks for sending in the questions. They're flowing in so fast I'm having trouble reading them. Here's one, and since I'm having trouble, I'm going to skip to our canned ones. The first canned one is several people during registration in the last webinar asked about special military service credits. Is there something that we have to do to get those? How does that work?
Yeah, excuse me. Without getting into a lot of great detail, here's a quick summary of the applicable dates and how it will potentially affect your Social Security benefits. If you served in the military after 1956, you paid Social Security taxes on those earnings. Since 1988, inactive duty service in the armed forces reserves, such as weekend drills, has also been covered by Social Security. So under certain circumstances, special extra earnings for periods of active duty from 57 through 2001 can also be credited to your Social Security earnings record. Specifically from 1957 through 67, extra credits will be added to your record when you apply for Social Security benefits. From 68 to 2001, nothing needs to be done because those credits have already been applied. And after 2001, there are no special earning credits available at all. Everything's already been applied to Social Security. So anything after 2001 is a moot point.
Good, and a couple more people have asked the VA question. So what's the relationship between Social Security benefits and VA disability benefits? How do we think about that?
Let's see, VA service-connected disability. Let's talk about that first. If you're getting VA benefits due to a service-connected disability, your payment amounts won't affect your Social Security benefits. Conversely, your service-connected VA benefits are not reduced if you get Social Security benefits. However, let's look at a non-service connected disability. If you're a veteran getting VA benefits because of a non-service related disability, your Social Security benefits are not affected. However, your VA benefits are reduced by your Social Security payment. Non-service VA benefits are income-based, which means that any other income source, such as Social Security, will reduce your benefit amounts. And as of 2012, your VA benefits are reduced dollar for dollar by that Social Security payment.
Okay, good. I'm going to go back to your picture as I tackle a couple more here. So I'm going to take this one, find it in the list. This is about our pricing. So the question is the $250 Social Security analysis fee for just the AAFMAA member, or does it include a full analytic review for member and spouse?
No, it will be for the member and the spouse, and that's really, you know, the best way to look at this is to incorporate all of the income sources in order to be able to come up with the best strategy. So it's not just for the member, it's a household type of situation.
Yep. I am looking at literally dozens of questions here, and most of these, Russ, and this is the same thing we saw this morning, most of these are asking very specific questions about recommendations for an individual. So I'm learning the ages of the different couples that are watching the webinar and some of their particular situations, but those are hard questions for me to put to you right here.
Yeah, those broad-based questions the individualized questions are much harder to answer in this type of forum, but that's exactly why, you know, we would like for you to reach out to us and let us help you with this. We can have the conversation one-on-one. We can run the report, you know, myself or one of our business development officers or perhaps our director of financial planning. Someone will be able to go over this with you directly and answer your questions more specifically with the data in hand. So, and I know I've seen some of the questions myself, Steve, and a lot of them, you know, have come in with very specific things that sometimes even incorporate some of the assets that they have, that they're currently working, expected working timelines, things of that nature. those kind of extra inputs would be best utilized in a comprehensive financial plan where we can really add all those additional inputs and drive it out a little bit deeper. The limited amount of information that we take in from prospects is going to be just based on what the best claiming strategy is. But if we have the opportunity to sit and talk with more information and dig a little deeper, we can provide a lot more detail on what the potential outlook looks like.
Thanks. I didn't ask a question, but that was a great way to sort of wrap this up. Those were great questions everybody asked. I appreciate it. I know, as we were just discussing, that we didn't fully answer most of your questions. I know you'll probably think of other questions that you want to ask later. In these cases, please reach out to us here at wealthmanagement@afma.com. You can see the email address right there on your screen. Our website is below that, wealth.afma.com. And so there are a variety of ways you can connect with us. We have a recording of this that we've made. You will receive Saturday morning or Saturday afternoon instructions in a follow-up email that looked a lot like your confirmation messages you received. Then we'll have a link to this recording, so you'll be able to view it or share it with your friends then. You can always sign up for future webinars or review past webinars at that address, wealth.afma.com. Again, if you found this information useful, please do share it with your friends and family. Our membership grows stronger every year because you introduce your eligible friends to AAFMAA. So we hope you're going to join us again in January for our next webinar. We always do this on the second Thursday of the month. And at that webinar, our President and Chief Investment Officer is going to provide his 2016 market outlook. So thank you, everybody. I appreciate you joining us. We hope this was beneficial, and we look forward to being of service. Thank you, and have a great day.